Good afternoon. Thank you for joining us. My name is Michael Filer, Managing Director, Private Wealth Management with Palisade Capital. I have been with the firm since its founding 26 years ago, although our roots trace back to 1969. For those who may not be familiar with Palisade Capital, we are an independent investment advisory firm who act as a fiduciary on behalf of our clients. We currently manage over $5 billion in assets, 2/3 for institutional clients and the balance for private wealth families. We focus on fundamental, bottom-up research-intensive investing. We advise individuals and families on how to preserve and grow their wealth. Private wealth is the cornerstone of our business, and we are proud of the fact that many of our client relationships span multiple generations. Today marks the inaugural session for Palisade University, a newly created platform to provide ongoing investment education covering a wide array of topics. And by the way, for those who are listening today, appreciate it. If there's any particular topic that comes to mind, please feel free to email myself or any member of the PalCap team. In this two-part course, we will cover both stocks and bonds and discuss the importance of these two asset classes within portfolio construction. Today's webinar will be given by Todd Rosenfeld from Securities Trading Corporation. Todd is a longtime friend of the firm who possesses a wealth of knowledge and expertise on this subject matter. Incidentally, my father, Jack Filer, worked with Todd in the mid-'80s, where they trained students to become stockbrokers and advisors. Again, appreciate everyone's time today to attend this virtual event. And without further ado, I will turn the program over to Todd.
Thank you, Michael. I appreciate it. I also appreciate this opportunity to do this presentation. The goal that actually my company has for a long time is to provide educational services to people both in the financial service industry or who are serviced by people in the financial service industry. And one thing we want to do today is try to take the mystery out of terminology in the financial service industry. So let's get started with some of the information. Okay, so the agenda for this presentation is why we invest our money, how we allocate our assets once we invest our money, some basic terminology of equity and fixed income. One of my favorite slides, 4, is volatility of equities. Then we'll talk in detail about equities. And then we'll move on to market cap or market capitalization. Some of you may have read today in the journal or watched CNBC where a company known as Tesla finally crossed a very important threshold. Their market cap is now $1 trillion. That's with a T, $1 trillion. Then we'll talk about the stock market sectors. We'll take the mystery out of growth versus value. Discuss a little bit about international equities, and lastly, active versus passive equities. And maybe sometime at the end, we'll do a little Q&A. Always happy to answer your questions. People always ask me, how did I learn so much over my years in the financial service industry? Yes, research is one of the answers, but one of the better answers is by asking questions. Never be afraid to say you don't know something, and ask someone who's knowledgeable about that topic. That's how we all learn in any presentation or anything. Why invest our money? Well, you may have heard of this term called the time value of money. And the time value of money basically says that if you invest $1 today and you watch that money grow, it'll be worth a lot more in the future. The reverse of that is sometimes called the present value of money. So for example, if you had $1,000 today and you invested that money, that would grow over a certain period of time to a certain dollar amount. If you were to receive $1,000 in the future, it'd be worth less today. That's referred to as the present value of money. Number 2 is compounding. This is one of the most important factors in investing. It generally says when we invest our money, there might be interest, there might be dividends, and there might be growth and gains. We take that money, we reinvest it. In just a minute or two, I'm going to show you the benefit of starting early and reinvesting your money. And remember, the earnings portion consists of dividends, interest, and growth. And remember, some stocks, as we'll learn later, may have a higher percentage of their earnings paid out in dividend, and some companies may have a lower percentage of their earnings paid out in dividends. And who can forget a very popular topic today, inflation. So a couple things you should know. You may hear people talk about the real rate of return. And the real rate of return is the return you receive on an investment less the inflation rate. So today, if you say, well, I'm getting 1%, I'm happy, I'm getting 1%, I have very little risk. Well, if inflation's 2%, you're earning 1%, you're losing 1% a year. That's a negative real rate of return. Equities over a period of years have provided the best hedge or inflation against inflationary risk, which some of you may have heard of this term, purchasing power risk. Inflationary risk and purchasing power risk mean the same thing. And that's another point we want to make, is that in the financial service industry, there are many terms and definitions. And sometimes that can be a little daunting to people who don't have that expertise. So remember, many of these terms can be easily defined, and that's one of the goals of this presentation, as well as our future presentations. One more thing about inflation is that if you have cash and you don't invest that money, in years to come, it will be worth a lot less. And lastly is time is on your side. Invest early and be diligent about your investment. Let's go to the right-hand side. One of the things we love when we teach are these charts and graphs. If we look down at the bottom, if we start at age 25 and we invest $10,000 a year at 8% growth, although we've invested only $100,000 over that 10-year period, in totality, the actual amount, because of the growth and reinvesting and compounding, is $156,455. Now, if you waited until you were 35 years old and started, that same amount, $156,455, would be worth that, but only when you are 45. And same thing, if you started at 45, by age 55, it would be 156. So one of my favorite is the top line. If you start at 25, at age 65, you'll be worth, that amount of money will be worth $2,797,000 and change. And look at that graph. Look at that dark blue line. That is a great thing, to be able to have that much money, because the hope would be when you get to that age, you can retire. You can still work if you want to, but you could retire because you have enough financial assets. And remember, besides your health, financial health is one of the most important things. Okay, let's move on to the next slide. Where we put our money, asset allocation. So we have two sides of the screen here. One, equities. And we have US equities, which are companies based in the United States. Although some of these companies may earn money overseas, they are based in the United States. And then we have large cap, mid cap, and small cap based upon the market capitalization of those companies. A little bit later on, we'll discuss more in detail what makes a company a mid cap, a large cap, or a small cap. Not to be outdone, and we'll talk more in detail later, we have international equities, companies that are based outside the United States. You may also hear the term periodically global investing. Global is a mix of both US equities and international equities. On the other hand, we have fixed income, otherwise known as bonds. And we have the slide broken down into some of the types of bonds based upon who issues or who's raising capital. We have municipal bonds. So I'm looking behind me at the beautiful George Washington Bridge. That was financed through the issuance of municipal bonds. You go to an airport, a stadium, they're all financed with municipal bonds. High schools, colleges, financed through municipal bonds. You're driving on the road, a lot of construction lately, a lot of it is financed through the issuance of municipal bonds. Next up is convertible bonds, sometimes known as a hybrid, kind of a mix of stocks and bonds. It's sort of like a little bit of each. And I want to tell you a funny story about convertible bonds. At least I think it's funny. So I always try things out on my family. And I figure if my family can understand it, anyone should be able to understand it. So I was trying to explain stocks versus convertibles versus bonds. And I said, here's the way you think about it. There are some people who go to the beach and they go right into the water and dive in. Think of those as they do equity investing. Think of some people who never go into the water, sit on the beach, never, don't even put a toe into the water. They may be more on the corporate bond line. Then there are those people that go in a little at a time. They go up to their knees, their waist, and then they dive in. I like to think of those as the convertible bond investors. I personally invest in convertible bonds. I think they're a great way in which you could receive interest and also learn to have the appreciation of the conversion if the stock goes up. A very famous investor, you may have heard of him. His name is Warren Buffett. He likes to invest in convertible securities. Moving down the line, we have government bonds, also known as treasuries. There are also agencies of the US government that also raise capital. And then there are corporate bonds issued by Apple, Pfizer, IBM, ExxonMobil, big corporations. And they're broken down into two, investment grade versus high yield. The nickname for high yield is junk or high yielding or speculative securities. I mean, junk sometimes has a negative connotation, but junk and high yield actually is the same thing. So it's based upon the rating. And if you stick around for a few more weeks and we participate in the fixed income session, we'll learn a lot more about the difference between investment grade and high yield securities. Very, very important, bottom of the screen. The appropriate mix between stocks and bonds or cash is based upon two major factors, time horizon and the risk profile of the investor. There are some people, even with a great sum of money to invest, do not have a high risk profile. That doesn't mean they can't invest in equities. It means they have to be picky about which equities they do invest in. Doesn't mean they have to have all their money in bonds or fixed income securities. Second is the time horizon. Let me give you two examples of different time horizons. One, you invest for yourself, and then you're going to want that money upon retirement. That could be a very long period of time, depending, of course, on your age. Here's a second example. You get married, you have kids. Those kids are eventually going to go to college. You may want to save money for their kids to go to college, which is not inexpensive. As I can tell you, I put 2 kids through college. And for that fact is they're going to need the money in 18 years. So if you start when they're 5, you have a 13-year horizon. If you start when they're 12, then you only have a 6-year horizon. So be careful of that. Okay, moving right along. Let's talk about the difference between stocks and bonds. So I'm going to do stocks first. They're going to move over to fixed income or bonds, and then we'll do a little compare and contrast. Number one, stocks, are known as equity securities. You're actually the owners of the company. So some of you may own your own company, or you may have a small company which you own, where you may own 100% or 80 or 90, some large percent. For publicly traded companies, most investors will own a very relatively small portion. Who's the issuer? Corporations like IBM, like Pfizer, as I mentioned earlier, Facebook. The status, the stockholders are owners of a corporation. So what's interesting is you might have heard people on the news, corporations pay tax, not necessarily, because corporations are owned by individuals and the individuals are the ones that pay tax. So again, not being political, just mentioning something I hear on the news. And of course, what is your return? Well, there's 2 types of returns with stocks. One are the dividends. 2 would be the capital appreciation or growth in the value of the stock. Now, I want to mention something, a little bit of an offshoot here, not on the screen, and that is the following. When a company earns money, has a profit after paying taxes, there's 2 things they can do with that money. One is retain the earnings, keep it within the company to grow the company. Number two, they can pay out a percentage of that profit in the form of dividends. So if someone says the dividend payout ratio is X, it's not overly confusing. It's the percentage of the earnings they pay out in the form of a dividend. So for example, if a company earned $1 and paid out 20 cents of that dollar in the form of a dividend, their dividend payout ratio would be 20%. To give you two examples, Apple's dividend payout ratio is 26%, but Pfizer dividend payout ratio is 70%. So again, just to give you a little bit of an example. Your principal is not guaranteed with stock. The risk is high. I'm going to like the word higher. It's higher than it would be as compared to bonds. You do have the right to vote. So make sure when you receive those proxy statements in the mail or however you receive them online, that you do have the right to vote. And these securities, most stocks, are easily tradable because they are traded on an exchange, a marketplace that brings buyers and sellers together. Moving over to the other side, fixed income or bonds. Here you are a creditor of the company. You are lending the company money to do something with that money, to build a plant, to grow the company, to invest in another business. And then in that case, you're going to receive the money back with interest. So a bond is a relatively simple thing. You lend an entity money, they agree to pay you that money back plus interest. Number two is who are the issuers? As we mentioned earlier, they could be a government, they could be financial institutions, they could be corporations. They could be a number of different things. Number three is the return. With a bond, unless it's a convertible bond, you're going to receive interest as a fixed payment. The screen just moved a little, and now you can see my glowing face and my wonderful hairstyle. So thank you very much to our trusted assistant, Claudia, for helping us out.
We're both follically challenged.
We're both follically challenged. Thank you very much. We appreciate that. Principal guarantee depends upon the issuer. So earlier we used the words investment grade and high yield. The higher the rating, the higher the probability that your principal will be returned. And the risk is relatively low as compared to equities, but it would depend upon the credit quality of the issuer. Remember, the US government has the ability to do something, heck, I wish I could do. If they don't have enough money, they can have something called a printing press, and they print more of it. I wish I had that every time my credit card bills come due, but that doesn't happen to me. All right. Now, the additional benefit with bonds is preferential treatment. Bonds have a higher priority in the company in case something negative happens over stock. And lastly, bonds are traded primarily in the over-the-counter market, not as organized as an exchange, but still has liquidity. And the more actively traded the bond is, the more liquidity it would have. Most bonds are readily tradable, especially the large ones. Okay, this is one of my favorite slides. One of the things I learned when I looked at this, and it's been a while since I've seen this, is that there's going to be ups and there's going to be downs. The question is, do not sell on weakness, do not buy on strength, because it's really, really hard to time the market. You know, people will say to you, well, I invest, I bought this stock, it's up 20%. Or I bought this stock, it's doubled in value. That's great. How many stocks did you buy? 10. How many went up? 1. What about the other 9? Oh, they went down, but I don't want to talk about that. So in essence, people, when you meet them at a party or a family get together or whatever it is, they're not going to talk about the stocks they individually purchased that are not doing well. No one wants to be considered a loser, let's say. They're going to discuss the ones that went up. But I want to show you something. Look where that arrow is, that top red arrow. And that was 2009. Sorry, I need my glasses. 2009. And it was up by about 20 some odd percent. But at some point in time during that same year, it was down a very large percent. So the dark blue line, which you see a lot of, is representing where the market was. Let's say the S&P 500 at the end of the year, the calendar year. And you can see there's a tremendous number of years in which the market is up more than down. In fact, since 1927, and no, I was not around, the average inter-year decline on US equities is 15.5%, but the average return annualized over that same period is about 10%. And out of the last 93 years, there's been positive 70 years. Think of your batting average, 70 out of 93, pretty good batting average. So even if you look at, let's look at 2020. Imagine if in March or the spring of 2020, the market was down and you sold off a lot of your equities. You would have not participated in a relatively great year at the end of the year. It was up. So remember, the market's going to go up and the market, yes, will decline. Nothing goes up forever. The key is be consistent. Trying to time the market is really hard. I leave it to the professionals. Look, personally, I know a lot about investing. Why? Because I teach it. But even myself, I rely on financial experts such as Michael to help me and guide me through that possibility. And no, again, he didn't pay me to say that. I really believe in leave the professionals, let them decide what the best way to invest is, and try not to individually pick in many cases.
And again, it goes back to what you said earlier about how critical the asset allocation really is.
Yes, it is. Great. Thank you, Michael. One thing I will tell you, just as a little bit of sidebar, I've been teaching for many, many, many years. I really enjoy teaching in front of people, and maybe sometime in the future, instead of doing this through a WebEx or Zoom or some methodology, maybe one day we can participate in some type of live classroom. That would be great. Love to see everyone's face. People can ask questions. And one great thing also about live presentations, in some cases, you can really gather other people are understanding and can do more examples that way. So hopefully in the future. All right, stock exchanges and indices. We hear the term a lot. Let's talk about it a little bit. If you want to buy or sell something that someone else previously owned, what's a good way to do it? It's called eBay. eBay is an exchange, a place in which people can buy and sell things together. Well, a stock exchange is kind of that same thing, but it brings buyers and sellers together. So when you buy or sell an equity security, stock, let's say, and you do it through Palisades Capital, of course, they're going to use the services of a firm who's going to go to an exchange where people buy and sell securities, relatively liquid. The price will change intraday, but you know within a very quick period of time, you'll be able to sell those securities. Okay, so let's go through a couple of examples. Oh, by the way, the two major exchanges are the New York Stock Exchange and NASDAQ. Those are the two major exchanges. The New York Stock Exchange has a physical location. NASDAQ is not, but it doesn't really matter. When you buy a stock, do you really care who sells it to you? When you sell a stock, do you really care who buys it from you? So sometimes people ask a very interesting question. What makes an issuer decide to list on the New York Stock Exchange or NASDAQ? Well, that's up to them, which marketplace. A lot of international companies like the name recognition of the New York Stock Exchange, and maybe the CEO or executives of the company want to do something they can only do once. You know what that's called? Ring the bell. I had a friend whose company listed on the New York Stock Exchange. He wasn't the CEO, but he was on the board. He says, Todd, it was really awesome. I got to be on stage and I got to ring the bell. NASDAQ has a lot of great things. They're just missing a bell. But they have another way of announcing their initial public offering. Okay, indexes or indices. You hear about the S&P 500, the Dow, and things like that. What that is a group of stocks that might have some type of similarity or some type of connection to each other. And they're designated to either participate in some form of the marketplace. Generally, indices are defined in two major categories. One is broad-based and the other is narrow-based. Broad-based indices follow the market themselves. Follow the general market, all types of securities. Some narrow-based indices follow a specific sector, like internet sector or consumer discretionals or oil and gas or other companies like that, or have some type of similarity. Okay, each index, we'll go through a couple. How's the market doing? Well, the Dow. Well, the Dow is only 30 of the largest stocks. You may have heard for many years there were not too many technology companies in the Dow, but recently there's been some more technology companies in the Dow Jones Industrial Average. And many people would only follow for many years the Dow, but today one of the most widely followed indices is the S&P 500, which are 500 of the largest companies in the United States. And remember, about 80% of those stocks in the Dow, Michael, pay a dividend. And about 180 or so of those pay a dividend of at least 40%. So there's a good number of stocks in the S&P 500 that pay a nice percentage of their earnings in the form of a dividend. And then there's another company called Russell or Russell Investments that has a number of other types of indices. The Russell 3000, which basically is 98% of the investable US equity market. It's a broad measure of the entire market. And next we have the Russell 2500 and the Russell 2000. The difference is the Russell 2500 consists of both mid cap and small cap. And hold on, we'll define that in just a few minutes. And the Russell 2000 is primarily small cap companies. Remember, some of those companies that were in the Russell 2000 move as they grow and expand their business into, let's say, the S&P 500. And unfortunately, I did miss one, the NASDAQ 100, which is companies that are listed on NASDAQ, 100 of the largest domestic and international non-financial based companies in the NASDAQ stock market. So a couple things I thought would be interesting on that. All right, let's move on.
Just one quick thing, Todd.
Sure.
So everyone, focus on here. Here's the S&P 500, and they think, here's the 500 largest companies in the U.S., but it's worth mentioning 6 of the 500 names represent about 20% of the index. So it's clearly not, and we'll get more. We'll discover a little later on, but clearly skewed by the market capitalization of the 6 biggest constituents within the index itself.
Thank you, Michael. Excellent point. Okay, speaking of market cap is a very simple definition that changes every day. And the basic definition of market cap or market capitalization, it's the total value of a company, and the formula is 2 things, and they're multiplied by each other. One is how many shares outstanding of the company. Now remember, outstanding shares represent those shares that can be tradable within the company. Now, sometimes a company will have a certain percentage of their stock, it's called restricted stock, which is not tradable. So you may hear the term public float. So if you take the outstanding shares and you subtract the restricted shares, Michael, you end up with the public float or the tradable. And many companies could have a public float of 30% or 50%, depends upon the number. Now remember also, the water bottle is in the way. Very good. Thank you very much.
We got the cue.
We got the cue. This is great. Not allowed to drink any water anymore. So remember, my throat's a little dry, you'll know why. But more importantly, you see our faces. All right, great. So again, getting back to it, if we take the outstanding shares, we multiply by the stock price. That's why the value of Tesla is now over $1 trillion. Why? Because the stock price keeps increasing. And as the stock price keeps increasing, the number of outstanding shares may not change that often, but the market price per share could change every day. So the market cap can change relatively. It can double in a year if the stock price doubles. Now we have here on the graph, on the right-hand side, we have large cap, mid cap, and small cap. Typically, large cap companies have a market cap exceeding 20 billion, mid cap between 5 and 20, and small cap less than 5 billion, which are still some nice sized companies. And you'll see 1 or 2 in just a minute. Now, on the S&P 500 front, we have Apple, Microsoft, Amazon, Google, and Facebook. And we see the percentages of those in that graph. And all of the others, so that's 19%, if we add the numbers up, quick math, all others of the S&P 500 are 81%. And a little bit later, we're going to talk about the benefit of what's called active investing, not simply passive investing and simply investing in the S&P 500 by finding a mix of stocks that may or may not be in the S&P 500, or some stocks you don't have to buy all 500. There might be 10 or 15 or 20 that might be beneficial for you. On the other side, we see another graph of the Russell 2000, small cap. And the top companies like Penn and Caesars, and you may have heard Caesars if you've ever been to Atlantic City or some place like that, one of the gaming stocks, they represent about a little bit more than 5% of the total. So that's the top 5 weightings in the Russell 2000 and the top 5 weights in the S&P 500. Remember, that could change. If some other company market cap increases, it could replace one of those companies, Microsoft, Amazon, Google, and Facebook. That's always a possibility. Michael, anything you want to add here?
Also.
All right, good. Excellent, excellent. Okay, moving right along. Now let's talk about the sectors. And the S&P 500, we have on the left-hand side of our screen, the various market sectors. We have information technology, we have healthcare, a number of sectors. We have real estate, we have consumer staples. Now on the right-hand side of that screen, we have brand names, things that you would know. Like for example, on the information technology sector, we have Apple. Healthcare, we have Johnson & Johnson or J&J. Interesting because someone asked me the other day, which COVID shot did I receive? My answer was J&J. My wife got Pfizer, which again is another stock in the S&P 500. And although I'm not a very frequent traveler to McDonald's, I do love the French fries, however. That's consumer discretionary, which means that consumers can spend money there. It's discretionary. It's not something they need to have. We don't need to have McDonald's. We may want McDonald's, but we may need to have it. I'm a bigger fan, by the way, of Chipotle versus McDonald's. Okay, that's just me. Communication services. I'm sure you might have heard of the company Facebook. Financials, we have JP Morgan. There's also Goldman Sachs. There's also Bank of America. There's also Wells Fargo, a number of other financial service companies, even companies like a BlackRock who are in the mutual fund space. Then we have industrials like UPS, consumer staples, things we need to have like Coca-Cola, utilities, energy companies like Duke Energy, materials like Sherwin-Williams, the paint company, real estate. You ever go to a mall? You'll see the term Simon Properties. They're real estate, among others. As also, for example, if you're in Manhattan and you see the Empire State Building, that is another part of a company called a REIT, Real Estate Investment Trust, which invests in real estate. And one interesting thing about a REIT is real estate itself is not a liquid. But if you want to invest in real estate, but have a liquid way to do that, that's called a REIT. I thought that was pretty interesting. And lastly, energy companies, gasoline, natural gas, things of that nature, among others. We have the ExxonMobil.
Just want to add real quickly. So Palisade's macro outlook is formed by the guidance of Dan Drew, who's our chief investment officer view of the world. And this really helps us determine which sectors we want to overweight, equalweight, or underweight. We continuously monitor the economic and political conditions and thus are able to pivot as the landscape evolves. At the end of the day, we focus on policy rather than politics.
Interesting thing, Michael. Has Dan ever appeared on television?
A few times.
I've watched Dan on TV. He does a great job. So again, I know that some people watch different TV. I'm a frequent viewer of CNBC, and I've seen Dan there many times. And sometimes if I'm with other people, I say, I know that guy. All right, great.
Thanks for the plug.
I know, it's no worry. Thanks for the water. I think for the water, I get at least 1 or 2 plugs. All right. Growth versus value. Growth versus value. Very important. So growth companies, we heard the term growth, are those companies in which their earnings are expected to grow at a faster rate than the typical average. Most, again, I don't like the word all. I like the word most or some. Most growth companies have sort of like a characteristic where they have a very low or no dividend. For years, everyone remembers Apple didn't pay a dividend. Now they do pay a dividend. Same thing with Amazon. Everyone thinks Amazon is a big, huge company. I remember teaching a class one time and explaining the following. And I was explaining convertible bonds. And I said, imagine for a second a company, everyone knows their stock, but doesn't know their name in the bond market. Because different investors buy bonds versus stock. And the financial expert, the investment banking group, goes to Amazon and says, well, if you want to issue bonds to build this factory, you're going to have to pay a pretty high rate because the bond market investors don't know you. So they said, well, what could we do? How can we issue a security that costs us less that investors want to buy? Answer, convertible bonds. So people don't think of it. These companies that you think of household names today weren't household names. Do you know that I taught another class about the IPO market in Facebook? When Facebook went public, look at its price today. It was $38 a share. So, or even Tesla stock, they have a lot of convertibles. So we do have growth companies. Typically, we look to make money on the growth side by price appreciation. And then typically the risk is higher. An example, of course, would be Amazon. One more other example. We take a company like McDonald's and we take a company like Chipotle. And people say, well, the price to earnings ratio, or PE, price to earnings, which is the market price divided by the earnings, market price by the earnings, divided by the earnings. Why is the PE ratio much higher with Chipotle than it is with McDonald's? And the answer is straightforward, because the expected growth rate of Chipotle is much higher than the growth rate of McDonald's. So that was, I think that's very interesting. Always find these things out. It's not that mysterious. You think about it, some common sense, and things that you know about.
So Todd, you mentioned IPO, just for the audience, stands for initial public offering.
Yes, I'm sorry about that. I should have defined that. I apologize. Initial public offering. Yes, thank you very much.
Sure. And also, regardless of the titling, we really focus on one primary attribution, which is quality. We look for companies with high quality characteristics, such as profitability, return on invested capital, high quality management teams with a proven track record. You want to find companies with moats around the business, high barriers to entry. We love those. We love those type of companies. In the end, it's about quality, and quality really outshines mediocrity.
Definitely, quality is important. Is the most important. Now, the other side is value. Value investing looks to buy companies that are below what their actual relative value is. Sometimes called the book value or net tangible book value, which is the real value of a company. Generally, the dividend is higher, and the profitability is both a combination of price appreciation and the dividend. There may not be as much price appreciation. That doesn't mean there's not going to be any price appreciation. Look at the price of JP Morgan Chase, the value stock. Very important value investor. Again, Warren Buffett, in the Berkshire Hathaway space, he looks to buy value. I've also heard of something else, Michael. The financial service industry tries to make up terms to satisfy something. So could something be growth and value? And the answer is yes. I've heard this term called GARP, G-A-R-P, growth at reasonable prices. I thought that was pretty interesting. Never underestimate the power of professionals in financial service industry to come up with a term for something.
Constantly selling.
Yes, constantly selling is right. Yes. And look at those charts on 2000, 2009, and 2010 to 2019, growth and value. Yes, price appreciation would be higher in the growth, but you also have more risk on the growth side. Okay. All right. Now, international equities. Companies that are based outside the United States, there's two ways to buy them. The more challenging way is to buy them overseas, not usually recommended. The better way is to buy them in the United States as you're buying a US stock. you may hear the term ADRs. ADR stands for American Depository Receipt, which are receipts of shares held of a foreign company that's tradable in the US. So, for example, in Japan, there's a company, Toyota, which you can buy in the United States. China, we have Alibaba. The UK, we have Royal Dutch Shell. So these companies mostly trade on US exchanges, and you buy them the same way you would buy any US company, but they're based overseas. And of course, who can forget, as my wife and daughter spend a lot of money there, the company based in Canada, Lululemon Athletica, which I didn't know that Lululemon owned Athletica until I saw this presentation. So thank you for that educational thing. We have Taiwan, we have Taiwan Semiconductor, South Korea. For those of you who like beer, Heineken is another example. And because my son likes playing video games, Nintendo is another example of an ADR not on here. But if we look to the left, we have the share of total worldwide market value, and we have the United States, which is a very large percentage, but it's not the whole world. It's a little bit more than half, 55%. So having a global view, a balance of US and foreign equities is an excellent idea. And one of the ways you can own foreign equities or international is by buying shares in the United States, which have really good liquidity, but of a company based overseas as an ADR.
Right. So, Todd, just real quickly, I would say 20 to 30 years ago, the thought process was simply buy the multinationals, and that's you sort of check the box on international exposure. And mention companies you've mentioned previously own the IBMs, the Colgates. You like that comes to French fries, McDonald's, right? The world's become a much smaller place.
Yes.
And we really value the importance of international securities. Generally speaking, the allocation to international is less than the exposure to domestic companies. We constantly compare the valuations of the foreign markets versus the S&P 500, and that really is a guide. It really helps us pivot in terms of the appropriate weight within the portfolio construction. And by investing in this asset, by investing in international, it really helps us cast a much wider net.
Right, and just like the United States, there are companies that are less risky or have a greater degree of risk in the United States. So some people may have heard the term emerging markets.
Sure.
None of these companies here are known as emerging markets, like let's say Brazil or Russia or Indonesia or those. So just like with a lot of other investing, just because you invest outside the United States doesn't mean your risk is going to double. It depends on which securities from which countries you purchase those equities in. Okay. And I think, Michael, this is our last slide.
That's correct.
That is our last slide. Drum roll, please. One interesting thing. I always used to wear a watch for many, many, many years. And since COVID, I don't wear a watch anymore. So hopefully you're all still here. And we haven't, I don't know the time. So again, I'm hoping our timing is good. That we're going at a good pace. I don't want to go too fast, nor do I want to go too slow to lose people. I know the attention span, if we can get done in 30 to 45 minutes, that would be great. Okay. So lastly, is the active versus passive. And I am really passionate about this, and I'll tell you why. Is active portfolio management is really good. I mean, there are times you say to yourself, okay, you could buy something at certain stores and not receive any service, or you can buy something at a store and receive a lot of service and get quality of what you're buying. And I like to equate that between now I know what time it is. Between active and passive. And active portfolio management means someone is choosing the individual stock. So not all 500, but what are the best 500? And to be able to buy and sell. That stock I might have appreciated enough. It's still in the S&P 500, but we might feel that on an active basis, we no longer think should be on our portfolio. The manager or managers believe in picking individual stocks based upon not just the companies themselves or the cycle of the market. The pros, you can outperform the index. They can show their work. So if the market is up by 10, but you're up by 12 or 13%, that extra 2 and 3% is usually important in the growth factor over years. And you can't look at 1 year. It's better to look at over a period of years because there could be up and down years. And especially in a year that's challenging, you say, well, I only made 1%. I said, well, the market's down 5%. So you did really, really well. Your trading is based on research, not index changes. And you are able to take advantage of inefficiencies in the marketplace. The cons, you may underperform the index. The expenses are going to be higher. Yes, quality is usually more expensive than non-quality. Just like going to stores. You're going to pay more for certain things, but you get better service, and there are advantages. There might be some tax disadvantages because you might have capital gains. But again, that money's being reinvested, and hopefully the growth will be in the future. And if your funds are in a retirement account, all taxes are deferred until you withdraw the money. And strategically, it can generate some what's called tracking errors where the indexes would have that situation. Now, on the indices side, we have passive investing, which is simply following an index. And you will perform, your performance will exactly equal the index you're performing, whether it's the S&P, whether it's the Russell, or some under index. Your fees will be less. That's a definite pro. The fees will be less. Performance may outpace some active strategy. That is a possibility. And it can be more tax efficient. That is a possibility. And that is a pro for passive. On the con side, performance could lag out of an index by fees. But again, if your return is 6%, that 6% is usually quartered less of fees. We use that term. Trading based on index can change, not research. And lastly, cost reflecting indexes, the cost for the fund to replicate indexes could be high. Okay, so that ends.
Just want to add just real quickly. So the way on the passive front, the way we typically our view of the world is that's typically used more for smaller accounts, as Todd mentioned, much more practical, much more cost effective. Typically on the active front, we adopt a very customized model to really satisfy one's needs and goals. And I think most important also is by owning the individual security, it really helps maximize tax efficiencies.
Yep, great. Thank you.
It's a very, very big pro.
Okay, I am going to stop sharing my screen. Let's do that. And there we are. Hello,
Great.
everyone.
Great.
Let's see. Are there any questions, Michael?
Sure. Todd, first of all, thank you very much. It was a very insightful presentation. Thanks for the folks who submitted questions in advance, and we'll get to a few as much as time permits here. Todd, the first question. I hear a lot in the news about a group of securities referred to as the FANG stocks. Number one, what does the FANG acronym stand for? And why does this group of stocks get so much love and attention?
Well, I'll answer the first question. So FANG used to be FANG. Then they added another company, and now it's FAANG. And it stands for Facebook, Apple, Amazon, yes, Netflix, and Google, which the parent company is known as Alphabet. And the reason I thought of play is they are very large companies and they dominate, and I mean dominate the sectors they are in.
Great, thank you.
You're very welcome.
Next question. While I'm sitting with my portfolio manager, several terms have been tossed around, and I just don't understand what they mean. Can you please provide some clarity?
I'd be happy to.
The three that they specifically asked about were ex-dividend date, current yield, and stock splits.
I will go over all three. The first one is ex-dividend date. The term ex in Latin means without. When does the stock begin to trade without the dividend? And the easy way to explain this is, if you buy a stock today, Tuesday, October 26th, the actual settlement date, when you are the actual owner, is 2 business days from the trade date. So if you buy a stock today, your name appears as owner 2 business days later. The ex-dividend day is generally 1 business day prior to what's called the record date. And the record date is the date determined by the board of directors of the company to look at who's an owner. So if you buy the stock on the X date, you're buying without the dividend. But the good news is the price gets lowered because you're buying without the dividend. The second one was current yield. Now, which is very interesting because it can change day by day. The current yield in a stock is also called the dividend yield. And it's the annual dividend, or sometimes the dividend over the last 4 quarters, divided by the current market price. Mm-hmm. But as the current market price increases, the dividend yield will fall. Mm-hmm. And the dividend doesn't change that often, but can change. Usually if it does, it's changed on an annual basis.
Right. And stock splits.
Stock splits refer to a stock price might go up. So for example, a great example is Apple. Apple stock price could increase, and the company Apple decides that, well, our stock is too high priced. We'd like to reduce the price by lowering the price per share. So if you owned 100 shares and there was, let's say, a 4-for-1 stock split, the number of shares you own would go from 100 to 400 because of 4-for-1 split, and the price would be reduced by 1/4 of that amount. So your dollar value would be the same, but the number of shares would increase, and the benefit is the price would go up. So for example, one of my kids received Apple as I'll say it, a bat mitzvah present many, many years ago, and there's been a number of stock splits, and the value of that stock increases, and she owns more shares, so it's a benefit.
Great. Next question. Todd, early in the presentation, you highlighted the importance of investing in the early years, especially given the compounding effect, which you did a very nice job illustrating.
Thank you.
I just want to add, to me, it reminds me of Einstein's famous line about compound interest is the 8th wonder of the world. This is one of the basic tenets of investing. They're asking, can you share some other valuable lessons you try to convey to your students over the last number of years that you've been teaching?
Yeah, don't time the market. If someone is an expert in doing something, you should rely on them in many cases. At the end of the day, it's more beneficial for you to do that. And then fees are important, but they're not the end all. I mean, fees are important, of course, but the actual return is more important than the fees paid, because again, when I say my return is X, it's usually net of fees. So those are a couple of things. And you don't always have to fall in love with the stock. It's much easier to buy something than to determine when to sell it. And that's taking the emotional side out. And professionals don't usually have that emotional side.
Buying is the easy part. Selling is a more challenging side of the equation.
Yeah, sell it, yes, definitely.
Todd, you spoke about passive investing.
Yes.
Also, for the benefit of the audience, can you please explain the difference between owning a mutual fund versus owning an ETF?
Sure. A mutual fund is a compilation of securities that are chosen by a portfolio manager. Now, they could trade them. Some could be active, some could be passive. You might have heard the term index fund. That's passive. There are also a number of active funds. And you buy them directly from the fund company, and their price changes every day based upon the value. But mutual funds are designed as long-term investments. They're not tradable vehicles. Conceptually, ETFs are just like stocks, but they're not one company. They're an index. So, for example, many people have heard of something called spiders, which is a term for the ETF of the S&P 500. So some people like to trade an index. They would do that through an exchange-traded fund or an ETF.
Great.
And you pay commissions when you buy an ETF, and you buy a mutual fund, you might pay something called sales charge.
Great. Next one up in the queue. Can you talk about the factors that typically would drive up or down a stock?
So the main factors are expectations to the future, not what it's worth today, what people think it's going to be worth sometime in the future.
Great. Looks like.
Let me look at the chat. There might be some questions here. Will these slides be available to review after the session? It's called definitely yes. Thank you for asking. Oh, okay. There's a killer to the answer there. Here's a very, very good one. With the U.S. as the world superpower, by the way, thank you for saying that. Thank you for saying that. How would one be able to globally diversify risk if the U.S. is in a down market? Assuming that the U.S. is a leading indicator for market stability, Wouldn't other markets soon follow suit? Mike, I'm gonna let you handle that one.
Sure. So again, we really focus on again the characteristics that we typically look for on in the foreign investments. Again, it goes back to us. It goes back to quality. So yes, there are, as you mentioned before, yes, there are times the market's straight up, market's straight down. We stick to our knitting. We know what we own. We're comfortable with what we own. By customizing the approach, that gives us some comfort, in case those particular stocks come down. It's about diversification. It's about asset allocation, and that ultimately gives us comfort.
And I will add that question is a very well thought out, great question. I think the person who asked that has a good knowledge of the market. So thank you very much for that very thoughtful question. As you can see, I let the professional answer the question. It's outside my area of expertise.
Thanks, Todd.
You're very welcome.
One more has come through the queue here. Why has the New York Stock Exchange lost some of its luster over the last several decades? Because it used to be known as one of the great iconic institutions in the world.
So the New York Stock Exchange was kind of slow to change with electronic trading. And because of that, people went other places. So if you look at the New York Stock Exchange today, that system of, buying and selling on the floor of a physical exchange is really not, I mean, you see people, you watch it on TV, the majority of trading is not taking place there. But the majority of trading is taking place electronically. So the New York Stock Exchange did not adjust to the market conditions. And that's one of the things that happens to a lot of companies, that they don't adjust for the times, and it gets outdated. I mean, anyone going to Blockbuster anymore? No. Oh, we see another great question. Do we think crypto will become more of a currency similar to the US dollar? Too high of risk with it? Michael, I'll let you answer that one as well.
I think right now we're going to have a separate session on crypto for the time being. So let's kind of table that, and we'll address it down the road. That's okay.
And I can tell you this, I know a little bit about crypto, but not much. But if it starts becoming a real active security and people start buying and selling it, exchanges and things of that nature as it moves forward. And my company does a lot of training for the various licensing exams. When they start putting that on the test, that's a test I got to really start learning about that information.
Again, so something we're paying a lot of attention to, and like I said, let's have a separate discussion on the crypto world.
Yes, not my area of expertise, but thank you very much for the question. It does get asked me all the time.
No doubt, it definitely garners our attention. Todd, again, on behalf of Palisade, the PalCap team, all the participants, thank you for joining us. Thank you, Todd, for presenting. And please mark your calendars. The second part of the session will take place, and will continue on Wednesday, November 10th, at 12 o'clock. Good afternoon, and thank you again.
Well, one more thing before we leave, and that is our next presentation when we do bonds. Feel free to ask any question. Remember that when you ask a question, I can see who may have asked the question. I'm not going to put your name out there. It doesn't matter. So feel free, because the question you're thinking of asking, probably the other people in the presentation are listening, probably have the same question as you. So feel free to ask any questions. I look forward to the next session, and thank you very much.
Thank you.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.